If you are hoping to buy a home this year, you are probably paying very close attention to mortgage rates, which you should, because it affects what you can afford. Home affordability is a challenge today, especially for those of you who are looking to purchase your first home. So it's a great time to look at the big picture of where mortgage rates have been historically compared to where they are today. But more importantly, you need to understand the relationship between mortgage rates and inflation, because that will help you gauge where mortgage rates might be headed in the near future. Freddie Mac has been tracking the 30-year fixed mortgage rate since April of 1971. That's a long time. Every week they release the results of their primary mortgage market survey, which averages mortgage application data from lenders across the country. So let's take a look at the graph on your screen. On the right side of the graph, you will see that mortgage rates have increased significantly since the start of last year. But even with that increase, when you look at the big picture, today's rates are still below the 52-year average. While that historical perspective is great context, buyers have gotten spoiled and used to mortgage rates between 3 and 5%, which is where mortgage rates have been for the past 15 years. That is important because it explains why the recent jump in rates might have you feeling a sticker shock, even though the rates are close to the long-term average. While many buyers have adjusted to the elevated rates over the past year, a slightly lower rate would be a welcome sight and relief for everyone, especially with home values that continue to rise across the country. So in order to determine if it's realistic to expect a drop in the mortgage interest rates in the near future, it is important to look at, you guessed it, inflation. We all know that the Federal Reserve has been working really hard to lower inflation since early last year. That's pretty significant because historically there has been a connection between inflation and mortgage rates. Again, looking at the screen, the blue line on your screen represents inflation and the green line represents the mortgage rate. So the graph on your screen shows a pretty reliable relationship between inflation and mortgage rates. Looking at the left side of the graph, each time inflation moves significantly, mortgage rates follow suit shortly after. So I circled the portion of the graph clearly showing the most recent spike in inflation, with mortgage rates following closely behind. If inflation goes up, mortgage rates go up. If inflation goes down, mortgage rates go down. That's what history is showing. However, as inflation has moderated a bit this year, mortgage rates haven't yet made a similar move, which pretty much means if history is any guide at all, the market is waiting for the mortgage rates to follow inflation and head back down. Quick disclaimer here, it is impossible to accurately predict where mortgage rates will go for sure, but moderating inflation means mortgage rates going down in the near future would fit a very well-established historical trend. So if history repeats itself, that may be good news for the future mortgage rates and your homeownership goals. Just remember that if mortgage rates head down, all of those buyers who are sitting on the sidelines waiting for that to happen will also jump in the market, and you may find yourself having to fiercely compete for the very few homes available for sale. And 9 times out of 10, when you do get into a bidding war for the house that you would like to buy, you almost always have to overpay in order to get it. So if you're planning on buying a home, reach out today so we can help you navigate today's market and ultimately achieve your home ownership goals on your terms. You want to find out how? Schedule your free consultation today. Link is in the description box below.